G'day guys, welcome back. In this video we are going to talk about different types of ETF. It's called covered call ETF. ETF itself is provided by BetaShares under the ticker code YMAX. YMAX. It is called BetaShares Australian Top 20 Equity Yield Maximizer Fund. These are the benefits of YMAX: attractive quarterly income, earned quarterly income, including franking credits, expected to significantly exceed the dividends yield of the underlying shares. YMAX seeks to enhance dividend income through what is known as covered call strategy. Wow, we'll talk about more in brief about what is covered call, and it gives you portfolio diversification of the largest 20 Australian companies and potential downside risk management. The additional income generated by YMAX strategy may partly offset potential losses in failing markets. Let's get into it. So briefly, let's talk about what is a covered call strategy they are talking about. This strategy is also called buy right strategy. And if you are not really familiar with the call option gives the buyer of the option the right, but no obligation to buy an asset at the strike price. Each option has the expiration date. Covered call option is when the seller of the writer of the option already owns the share in the contracts, hence the term covered. It's different from a naked call where the seller, the writer of the option, doesn't own the shares, and usually they need to show a cash as a collateral instead. So BetaShares are really promoting this ETF. They even have studies reported by a PhD, a doctor of philosophy, Tony Rumble, head of portfolio construction, BetaShares. But straight away, I don't buy it. As always, I don't buy a lot of things because it's quite biased. In the end, what I'm sensing is that the one that takes the least risk is ASX Limited. The one that takes a lesser risk is the fund manager, BetaShares, and the one that takes the most risk is the buyer of the ETF. I'm gonna demonstrate to you how this is so through this ETF, YMAX. So through the paper, they talk about the risks of buy right investing. Investor risks include the share price falls because the investor will generate cash by selling the call options and receiving option premiums. So the downside risk is less when the calls are sold than it would be if the shares were held outright. Because if the share price is below the strike price of the call options pretty much becomes worthless, and therefore seller of this call option gets the premium and gets the profit. Another risk is that the share price above the strike price of the call options. In this scenario, the investor will still receive some gain of the underlying share, but that share will be capped at the level which the call option is exercised. So what they're saying is that your gain is limited by the strike price that you put up high. So generally they put 5 or 7%. They try as much as possible so that the option is not exercised. According to the paper, typically buy right strategies can be expected to outperform a stock only portfolio in certain market environments, namely outperform in modest bull market, outperform in range bound market, outperform in a bear market. However, as buy right strategies involve foregoing some of the return from price appreciation of the relevant securities, such strategies can be expected to underperform in a strongly rising market. So what they're saying is that if the share price increase by quite a lot, the investor pretty much losing out because the profit that they ever can achieve is capped on the level that they set the strike price with. And the conclusion of the study is that the average outperformance of the equity income strategies was 4% per annum over and above the return of the underlying share portfolio. Just a reminder, it's not 4% per annum like covered call ETF will do 10 and the normal index will do 6. It's not like that. It's more like 404% over. So if the index ETF done 10, the covered ETF will do 10.4. So it's not a major outperformance. So YMAX has a net asset of $300 million. This is as of May 2021. So there's a lot of interest, and the unit of outstanding is about 37.2 million. He has a management cost of 0.76% a year. That's about $528,000 a year. There's also a famous US covered call ETF called QYLD, and they only charge 0.6%. So definitely better shares charge higher. And when you see a covered call and they're not showing you the transaction cost, because option trading is more expensive than just buying a shares itself, and the distribution frequency is 4 times a year or quarterly. This is the share price of this ETF for the past 8 years. The past 8 years is a negative CAGR of 3.3%, a 5-year CAGR of negative 2%, 3 years CAGR of negative 3%. So where are all the monies gone? Why is the net asset just keep decreasing? Where the research paper by the PhD, Tony Rumble, said that it will outperform. The answer is most likely is that the investor of YMAX is sacrificing CAGR for a higher dividend yield. But at what cost? And that's what we're going to go deeper on this. These are the sectoral weightings. Is quite irrelevant because it's pretty much ASX 20, the 20 largest company in Australia. And if you look at the fund returns after fees, since inception in 2012, it says has a return of 6%. So far, we've done the CAGR calculation based on the share price. We have negative 3 and negative 2%. So why do they advertising that they have 6%? So maybe it's from the distributions. So let's check it out. So I've already add up those quarter distributions into annual distributions. So this is the annual distribution they have paid the past 6 years. In 2014, they pay 99 cents. And interestingly, it's a steady decline. I wonder why. In 2020, they have paid 62 cents. So if you purchase these ETFs, say since inception, about $10.64. That's what I use as a dividend yield. So on 2014, your yield is impressive, 9.3%. But then in 2020, if you keep holding it, your dividend yield is actually decreasing at 6%. And if you average it the past 6 years, your average dividend yield is 7.8%. And if you subtract this dividend yield with the 8 years CAGR that we already calculated, negative 3.3, you can get the annual return of 2.5 from 2020, and all the way to 2014 you got 6. So average annual return is 4.5%. So definitely, if you look at the numbers, the covered call ETF will not outperform ASX 200 ETF. I'm interested is that why the negative return? So that means the net asset keep decreasing. Let's investigate further why is this the case. So they have 37.2 million. I got it from here. The unit outstanding is about 37.2 million. And if you times it with the distributions you get from 2020 of 62 cents times 37.2 million, that should come up with about $23 million. So you need $23 million to pay if Better Shares gonna pay the same dividend yield, if they can do it. So obviously the Better Shares distribution yield is misleading because it could be at any price that they are talking about. But if you purchase this ETF 8 years ago, the dividend yield is definitely quite low. Let's have a look at the ASX 200 index ETF. The past 3 years. The past 2 years, the CAGR has been great. It has done 5-6% for IOZ and STW, and they also pay quarterly distributions. However, the dividend yield is a lot smaller, at around 2%, which is reflecting corporate dividend yield of Australia. But if you add up the return from ASX 200 index, it's about 7.2%. So YMAX past 3 years, if you average 2.5, 3.8, and 3.8, the average past 3 years is only 3.4. So why the 3.8% below the index of ASX 200? Is it the strategy? Or is it, to answer that question, we have to go through the 20 companies that they're investing their money. It's quite a big fund of $300 million. And these are the ASX 20. And I'm guessing the way they distribute the money is based on the market cap. So we have CBA, BHP, and CSL on the top 3, followed by the 3 banks. And if you pay attention to Commonwealth Bank, they have quite a lot of position of 45 million. And what I did is that I looked through all the dividends from CBA, BHP, CSL, Westpac for 2020, and to track how much potential annual dividends that they produce for the period of 2020. And if I add them all up, because I know how many shares and units they have, they should get about 9 million dividends. So remember, we already calculate approximately to pay the dividend yield of 62 cents, they need 23 million. But the dividend yield is only 9 million. So 23 minus 9, that's 14 million. So where do they get the 14 million from? They're hoping is from covered call strategy. Has the option trading produced 14 million? Let's have a look. If you look at further, these are the contracts they're already involved with. Okay, so we already established that they cannot keep up the dividend yield. From their 300 million ASX 20 portfolio, they're only generating about 9 million dividend yield. How do they find the 14 million to keep up 23 million a year dividend yield? So let's look at deeper at the financial report in June 2020, and we estimate 9 million, but actually in June, as of June 2020, they actually receive a dividend of 11.9. So it's not far off, but it's pretty close. And the net gain or loss is due to the stock market crash, 45 million, so that's okay. But let's pay attention to the management fees. The management fee is really high, so it's 1.7 million. And expense recoveries and transaction costs is very high. The total expense for 2020 is 2.8 million. If you divided that by the total asset, the net asset from 2020 of $251 million, so 2.8 divided by total financial asset of 245 million, so 2.8 million divided by 245 million, that's 1.1%. So when I look at that, the total expense is pretty much as high as Wilson Asset Management, the active management LIC. So, and in 2019, 3.3 million divided by the financial asset of 312 million is about 1.1%. So essentially, the total expense is 1.1%, but they only report the management fee of 0.7% just to make you feel better. So definitely there is a problem here because the transaction cost is really high. If you compare the transaction costs of, say, ASX 200 index that BetaShares own is A200. A200 only spend $16,000 just purchasing share and not get involved in option trading. By involving in the covered call strategy, this transaction costs increased by 32 times, so 3,200% to almost $590,000. And if you compare the management fee plus transaction, the total expense of this covered call ETF YMAX and compare it with A200 is actually 5 times larger, and yet the A2 total asset is more than 2 times at 800 million. So YMAX only have 300 million and it costs more to run. So these are the asset and liability statement. There is a drop in 21% on net asset from 2019 to 2020, and I believe this trend will keep happening. We already seen that in the negative CAGR the past 8 years. And we can see because of the expense is really high as compared to ASX 200 index, and also the liabilities, they cannot keep up with the high dividend yield that they're promising with. They're promising a high dividend yield, but they cannot deliver that, so they have to just sell the shares, the financial asset. And that's what we're seeing. Of course, if you want to pay about 23 millions a year of dividends, you need to have cash of at least 5.2 million, and they have just enough for that. And if we look at 2019, net profit is only enough to pay 1 year of distributions of $24 million. So remember, the covered call strategy is supposed to reduce the risk to the investor. But in actual fact, if you read their own financial report, you would see that you are actually bearing the highest risk. So they have done this price risk section of the financial report, and it says the fund is exposed to securities and derivatives price risk. Whenever you involve derivatives, it's very risky. This arises from investment health, and during uncertain times, your risk is even higher. They even have done sensitivity analysis with a 10% price movement at the report date of the market price attributable to financial asset, and they'll see the impact on the fund operating profit and loss. So 10% price movement will give a change of positive 14.8 million, but negative 10% price movement will give a negative 22. Well, hold on a sec. How come it's not equal? So what they're saying is that if the price of the shares go up by 10%, you will only gain 6%. So I got 6% by dividing 14.8 million with 245 million. I get 6.0%. And if you divide negative 22, and if you divide 22.2 million by 245 million, you should get negative 9%. So in a normal ETF, in say ASX 200 index ETF, a plus 10% will give you 10% plus. In this covered call ETF, you are losing out 4% because your increase is capped by the option strategy they have placed. And the fall, if you 10%, is slightly less. You won't get negative 10%. You will get only 9%. So you're safe by 1% with this option call. But if we add up the 14.8 million with 22 million in the normal ASX 200 index, it should come up with 0. But with this covered call ETF, you will end up with negative 7.4 million. And we all know nobody can predict the share price, whether it's going to go up or go down. If it keeps going down, you can tell that you are already playing a negative sum game. It's already 3% risk to the investor. Beta shares don't lose money. They keep charging 1% expense a year. And ASX doesn't lose money. They only clear the option transaction between two parties. But the investor are losing the most. Not only they gain is cap, but also they're paying high transaction and management fee. So to sum it up, guys, ASX research by a PhD is biased. Don't believe it straight up. Always do your own research. Even after watching this video, always do some research. They say a slight 104% is irrelevant. If the investor are charged with 1% a year of management fee and transaction fee, a 4% slight outperformance means nothing. And total return underperform a traditional ASX 200 index ETF. Although you have a higher yield, but it is a very costly ETF. Remember, we already show you they advertise 0.7, but really they're charging the investor 1.1%. And they say the fund will perform better in the lower volatility marketing. It means nothing if it is a negative return. And I hope this ETF will be gone very soon. And we already gone through the sensitivity analysis. The covered call, it doesn't add up. It's a negative sum gain. And what's worse, this ETF selling call option up to 100% of the portfolio. If you compare it with another LIC, it's not ETF, but this LIC Jaguar, they use call options. They only use 20 to 50%. And look at the share price. It's very irregular, and they cannot deliver in strongly increasing steady dividends. That's why they have a negative CAGR of 3.2%. It's interesting too, the negative 3% always appearing. I mean, we already talked about it's a negative sum gain to the investor. Covered call ETF or any option trading LIC is a negative sum gain, where ASX and the broker and the fund manager wins because they charge a high brokerage fee or derivative clearing or closing fee, and better shares takes the least risk and the investor take the highest risk. If you don't agree with me, please leave a comment below. Thank you so much guys for watching, and I'll see you in the next video.